Hi, everyone. This is Bronson. I'm with Nighthawk Equity, the passive investing arm of the michaelblanc.com. I'm here with Michael Blanc, the CEO of the Michael Blanc, as well as Nighthawk Equity, as well as Drew Niffen, the president of Nighthawk Equity. So welcome, gentlemen. Today, we're going to talk about are the risks of multifamily. So we'll start with Michael. What are some of the risks involved with investing in multifamily?
Yeah, one of them is a certain sense of illiquidity, right? It's a major disadvantage of multifamily because investors are tying up their money for several years, 5 years, 6 years, 7 years, whatever the case may be. And we talked about the benefits in a previous video, which are amazing. A great performance during down cycles, above average returns, and extraordinary tax benefits. But the one thing, the disadvantage is that it's tied up for a period of time. The other risk, of course, is recession. There are things that may happen that are outside of our control. And so, again, multifamily did behave very well in the last recession for sure, but certainly if there's a recession, it will have an impact on almost any kind of investment, whether it's any kind of real estate or a different asset class, and it's going to have an effect on gold, on oil, and certainly on stocks. So recession is one. Choosing a poor operator and or a poor property manager, that is probably, I feel, one of the biggest risks as well, is choosing someone who doesn't have the track record and the experience of one. To some degree, there's a risk of overbuilding in an area, right? So if there's a lot of development going on, a lot of new units are being built, there's a risk of that driving the occupancy down or the rents down. On the other hand, though, a lot of the types of multifamily that we do tend to be more of Class B, or Class C even, that are built in the 80s or 90s, and they're relatively affordable. So in an overbuilding, those are normally Class A, very new luxury type of building. So the overbuilding typically doesn't affect the Class B and Class C as much, but it's certainly a consideration. Also, another risk could be legislation change. This really depends on the kind of investing you're doing. So if you're investing in, for example, Section 8 subsidized housing, there could be legislation that would change that program or possibly make it go away. It hasn't happened in over 50 years since it was conceived, but it's a possibility. If you're investing in Airbnb, there might be legislation affecting that. So there's specific risks around the different asset classes.
Thanks for that, Michael. Hey, Drew, I know you work with a lot of our passive investors here at Nighthawk. How can our passive investors be conservative and mitigate some of these risks that Michael mentioned?
Yeah, absolutely. Good question, Bronson. So we get this question all the time. And whenever we analyze deals, whenever I get deals into the Nighthawk Equity, I'm always looking at it through the prism of how can we be conservative and how can we look at this asset. And even if things don't go according to plan, will it work? So we have a couple underwriting guidelines that we use and that anyone can use to be more conservative in their underwriting. So number one, what's your debt profile when you're going into a deal? Are you coming into the hard money loan? That's really risky, right? Anything can go wrong and you're tipped over. Or on the other side of the spectrum, are you coming in with long-term debt, a 5-year fixed rate debt or a 10-year fixed rate debt? That's a much different thing. That's much more conservative to have that long-term debt. Number two, don't buy properties for appreciation on the hopes that they'll blindly double. Instead, be buying things for cash flow from day one. So in year one, is this going to be producing cash flow? Yes or no? If it is, then even if there is a recession, you can pay off that mortgage every month. You can maintain the property, afford to market the property, get tenants in there. You'll have cash flow. Cash flow is the best way to make sure that you're buying the property that'll survive those recessions. Number three, when you look at a property, we always assume that the market might be a little bit less favorable when we're selling it. And we stress test the model through that. So we call that, increasing the cap rate. It's a financial metric that we use to underwrite deals. So if you look at the deal and assume that the market's going to be worse when you sell it, and it still makes sense, then you're being conservative. A fourth thing that we do is every single month, when we look at our profit and loss statement, we are writing in an expense line for reserves, for putting money away for that rainy day, for the roofs or for a new parking lot or other large ticket items, for putting in new boilers. So if you're putting money in every single month, even if there isn't a real expense, then you're going to have money for when those bad things do happen, right? So you want to do that and do that in a way that is representative of how much money you really have to spend on those things. And then lastly, the last thing that I do to be conservative is I try to take conservative rent increases. So for instance, in some markets, Vegas, Phoenix, West Coast, there have been rent increases in the last year or maybe 2 years ago that were 5% year over year. Those are huge rent increases if you look at that as compared to normal rent increases. So if you look at a longer term trend, you'll see the averages are usually 1.5% to 2.5%. And we don't really vary outside of those metrics when we're putting in what our rent increases are. So having low rent increases is a way to be conservative about your underwriting of a deal. So 5 things. What's your debt like? Getting cash flow on day one. What are your cap rates? Putting in reserves every single month and having conservative rent increases. Those are ways that we look at deals in order to be conservative and sort of be able to be prepared for when the recession does come.
Thanks, Drew. That was great. Thanks, guys. And I know one thing that we're all passionate about, I think we're all of, I think speak for all of us, is that we love helping people do deals. So that's something that we love doing. And we also love people that are not just going out finding their own deals, but people that want to invest and be involved on that level as well. So that's one thing we do here at Nighthawk Equity is we help people that are interested in being involved, but don't necessarily want to go out and buy their own apartment or buy their own duplex or kind of manage it themselves. So we also, that's kind of why Nighthawk Equity is here. So if you haven't already done it, go to nighthawkequity.com/invest and join the Nighthawk Investment Club, and we'll get to know you. We'll start a relationship, and then we can potentially maybe do some deals together. So we'll see you on the next video.